Hi everyone and welcome to this software as a service deep dive event. My name is Kasper and I'm head of research for HC Andersen Capital, and we have Antti with us from Inderes.
Hi everyone, welcome.
Yeah, today's topic is to look into the life cycle and investment phases of different software companies over the next 2 hours. We have 3 different companies with us today and the management, and hopefully these companies will shed some light on on how this works for them and what considerations they have. The agenda is provided over to the right one. Antti and I will start with a short introduction and setting the scene for today. Afterwards, we have Faundit and the CEO Kasper with us, and afterwards Penneo, also Kasper, and the end Efecte, Nilo. So we have 3 different companies. One is Bootstrapped, the second one is heavy growth investments, and finally Efecte, which is in a more balanced growth investment phase. We will look more into these categories now. So the next 15 minutes will be a short introduction about the software as a service sector. Why is it relevant, and why is this topic very relevant for investors also to understand? But so first let's start out. I will just move up in the helicopter in the beginning and take a step back for maybe some new viewers into this sector. Providing a short definition, Salesforce has a definition here saying that software as a service is a way of delivering applications over the internet as a service. Instead of installing and maintaining software, you simply access it via the internet, freeing yourself from complex software and hardware management. So if we take this definition and taking it from an investor perspective, this sector is very, very interesting to look into because of the scalable business model and also the recurring revenue from these software contracts. We also see the sector is having some tailwinds from the secular trends such as digital transformation, automation, and artificial intelligence. Of course, there has also been some headwinds in terms of the current macro environment, looking at the valuations in terms of the higher interest rates and how this has affected the growth stocks and of course also the SaaS stocks. So right now also you can see on the other hand the valuation level is historically low when comparing to last year when we see the record high valuations, and this is something that we will just shed light on now before we move more into the topic. So the way we are doing it in HC Andersen Capital is that we have monitored the price over the ARR multiple. We have 19 listed companies. Most of them are, you can say, pure play SaaS, and some of the others are more like, some of this is non-recurring, so it's not totally ARR based, but also some consultancy services and so on. But taking the ARR multiple, we have seen the huge decline. Last year in September, it was about 15 times ARR. Now it's more like about 5 times ARR. And most of these companies are early stage companies being IPO'd last year on the First North market, where we have seen some large growth rates, but many of these companies are also in problems now or are having some problems with the business model because they need to raise more capital, and this is very hard in this environment, as we will get back to. But look on the Finnish side also, Antti.
Yeah, so what Kasper mentioned about the valuations going lower, we see the same trend in Finland, but in the Finnish chart you are able to see the trend a bit further away. So the Danish chart is until 21 and ours is until 2017. So in the long term we actually see that the valuations in Finnish SaaS companies are quite on the level where they were some 3, 4 and 5 years ago. It's good to note when you look at the exact multiples that we're looking at forward-looking multiples for the Finnish companies, and also we're looking at the full revenue base. So not all of the revenue that SaaS companies bring is ARR, so the recurring revenue. So if you take these factors into account, I believe we're somewhere roughly on the same level. And also good to understand that in the Finnish stock market, the companies have actually matured quite significantly over the last years and are now in a more stable financial position. So from that point of view, the same multiple today might actually be considered more attractive than it was 3 or 4 years ago.
Yeah. And also what we can see from the multiple contraction is, like I said, that last year or also in 2020 after the COVID-19, we saw that the high risk appetite increased a lot, and there was so much focus on the growth, and companies could easily attract new capital to invest in the growth. But now we have seen a new regime coming up due to the of course the macro uncertainties, or inflation and the interest rates rising heavily. So this changes the multiples and have contracted it very much recently. So in this event, we will try to look at the capital situation and align the companies, how they are working with the cash and the investment phases, investing into growth, and how the trade-off is between the growth and the cash flow. So we would like to look into what the perspectives are on this, and understand why some companies are burning cash, and also when and why it makes sense. So before that, we will just introduce into these investment phases, and this is something that you will help us with, Antti.
Thanks, Kasper. Indeed, so what we want to go through in this event is why you should, as an investor, understand the different stages of a SaaS company's life cycle. So this really affects how you should look at these companies and what's important. So if you look to the left and think of the different models of how a SaaS company is started and grows into a scalable and cash flow positive model, typically the company starts by finding an efficient growth model, figuring out the product market fit. And I would say Faundit, that is doing this in a bootstrapped way, so not burning cash, is now in this stage.
So the logo should be moved up a bit in the slide.
Indeed. And then when the SaaS company knows what the growth model is, it makes sense to invest further into that growth model, so you get good return on capital. Of course, there's two ways to do it. If you are not using financing, you're going to be bootstrapping it. So if you look to the right, you might actually be running a neutral cash flow up until you have sufficient scale to actually turn a profit while growing. But if you have financing, like many companies in the public markets do, they often tend to do growth investments upfront and make negative cash flow, and finance this with for example, cash that they have been able to raise in IPOs. And as an example, we have Penneo from Denmark that is now in this heavy growth investment phase. And finally, when the company reaches sufficient scale, they're able to make more delicate decisions about should they increase the investments in the growth, or should they actually take in some profits. And we have Efecte as an example of a company that has reached this stage. But in any case, there are many ways for the company to run these three phases. And today you'll get some insights from the companies that have been living through these phases and what is really important to them. Because not all metrics should be interpreted in the same way in each of the different stages. And Kasper, can you go through the metrics, what we're looking at?
Yeah, so all of the metrics are not here, but we have just highlighted some of the important SaaS metrics. And this is customer acquisition cost. So how much capital does the SaaS company spend on acquiring a new customer? And in relation to that, you can measure on the CAC payback period. So when is the money invested in acquiring a customer earned back? So these are some of the simple ones, but there is some assumptions behind it. So that might be some differences between SaaS companies reporting these metrics. So be aware of this when you're looking at the financial reports, that some of them may include different costs in terms of these ones. And also looking at the customer lifetime value. So how much value does one customer generate, or the whole customer base? You can also measure it on that way. And here you need to know the churn rate or some assumptions behind it. You can use historically, but of course, what is the future one, we don't know, but some companies are using a conservative churn rate. We need the average AR per account, or adjusted for gross margin also. And you can use some ratios or some bit between the CLV and the CAC ratio to know how good is it looking for this company, or when does it make sense to invest in acquiring a new customer. So again, there's a lot of drawbacks here with these SaaS metrics, and we have a lot of more worth looking SaaS metrics such as the net revenue retention rate, using the upselling and the churn rate also included in this. And but for this event, we are kind of looking more into the clean SaaS metrics. So no assumptions made, more capital efficiency, such as the free cash flow over the net new ARR over a period of time. So we have a ratio here, and also the rule of 40, which may be better for the more mature companies. So maybe not that relevant for most of the early stage Danish companies, but at least the insights of balancing the free cash flow margin and the revenue growth is also something that we discuss through the event, and also having the ratio in mind, that we are looking at how much money does one company spend in cash flow when comparing to how much net new ARR is generating. So for example, if you are spending 2 million in the cash outflow, then if you gain 1 million in net new ARR over a period, you have a ratio of 2 or -2 if you take the free cash flow. So this is something that we will look more into, and Antti, you have provided some table here on the next page.
Sure. So this is a perspective from us as analysts, how we look at the company when they do burn their cash. So for a SaaS company, just like any other company, it's about capital allocation. Are you able to invest your cash into business with a higher return rate than your cost of capital? Now, in SaaS companies, it's hard to interpret EBIT, for example, because you're doing your investments in your profit and loss statement. So it's not the same as looking at the return on equity ratio for an industrial company with assets in the balance sheet. So I'll give you 2 examples. So if you are burning 1 million in cash to get 1 million of new annual recurring revenue, and you have 80% gross margin, that means you get 800,000 in a year back from that investment of 1 million. And now if you lose 10% of your customers per year, you'll be landing a 70% IRR return rate. So if you're a company that's able to do investment into customer acquisition at this high return, it makes sense to burn as much cash as you can, right? As long as you have access to it. In another scenario, for example, if you're in an early stage company and you're not yet ready to scale up your cash burn, you might be spending 5 million in cash to get 1 million in new ARR. You might also have a little bit worse gross margin at this point, but maybe something similar in terms of churn. In this calculation, you're actually getting a return of 4% on the capital that you invest. And in this case, it's very expensive to acquire new customers, and you're actually burning cash that destroys long-term shareholder value. Now, what needs to be noted is that for an early-stage SaaS company, it makes sense to be doing some investments to figure out your sales model. So if you're looking at the small early-stage SaaS, their metrics are not going to be as good as they will be in a heavy investment or a balanced growth company. And it makes sense because the point is that they're building the model that is going to bring those good returns in the future. Just as long as the company isn't burning cash erratically at that point, at the low return rate, as an investor, as long as the company is making progress in terms of improving the return, you can trust or at least get an indication that the company is later on able to invest their capital in a very efficient way. And typically, when a SaaS company goes into the heavy investment phase, they should have a return rate for the customer acquisition investments higher than their cost of capital, which for many companies is something between 8 and 12%. And on the right, you can see a table of calculations. So if you have the ratio between how much you spend cash versus how much you get ARR, and then depending on how much margin you get from that annual recurring revenue, what is the IRR return if your churn rate is 10%. And from here, you can see that there are many ways to burn. It's easy to burn cash in a way that destroys shareholder value. But when you get your metrics right, you're actually able to be a compounder that reinvests cash flows into the company.
Yeah. We will send this out afterwards so you can see the slides and so on. But for now, we are a bit in a hurry because the first event or the first presentation from the company Faundit will start in a few minutes. So I will just very shortly tell you about the structure of the upcoming presentations. We will start with a short introduction of each company, or first Faundit, and then I will be the moderator and try to ask the same 4 questions coming up for these presentations, and then I will kind of structure the way we are making this presentation so that we are trying to ask the same questions for all 3 companies and get some different perspectives on that. So now welcome back again. We are ready with the first company presentation, Faundit, which is a smaller Danish SaaS company in a bootstrapping phase. Welcome, Kasper.
Thanks, Kasper.
Before I ask you some of the deep dive questions that I just mentioned before in the introduction, I will just let you give a short introduction to Faundit and what you are doing, so the viewers can see how the business model works and what you have created here. So please go ahead.
I'll just take it away. I'll keep it short because it's actually super simple. So basically, we're doing a software that primarily targets hotels, but we also do more. And hotels are great because lost and found is just a mess for hoteliers. It's a lot of coordinating back and forth. It's the typical go-to headache. So that's what we solve for them. Basically, we take care of everything regarding communicating with the guest and figuring out how they can actually get their items back. And just a brief on our team, we actually automate everything. So that means we can do it with a very tiny team. We do also have an advisory board, which we realized would actually give us a lot of benefit during this COVID period. So they can actually also benefit a little bit and contribute with some commercial value, especially our chairman, who is really, really well connected. So there's a lot of value in that, as well as some kind of a team member. And yeah, I'm just jumping through it quickly. So Kasper, please jump in if there are any questions.
Of course, yeah.
And a bit about the business model, because the product is quite easy to understand. Then we actually separated it into 2 different business models. The first one was one that we did before COVID, back when we were fully bootstrapped, no one on full time. So that basically meant that we did a product completely free of charge. That's what we call the entry model now, which basically is something that the hotels got for free, and we were solving a lot of headaches and making a lot of guests happy. And we earned a good revenue on all the shipping, which basically came in our coffins as profit margins, which we negotiated. Then COVID happened, and we were basically on 2 years of lockdown, so we had a lot of time to actually build a good product and a good company. So we built what we call the Pro, which most are actually subscribing to now, and this is basically what everyone new one is subscribing to. So we have about a third, or perhaps even half, of all of our current members are on this Pro solution, where it's just the regular subscription model that you guys know. I'll put down churn as to 20% because honestly we don't know. We are a smaller company, so we don't have the significant number of scales to actually know the exact churn. I think I'll stick to that a bit later. That was the introduction, I think, Kasper.
Perfect. So you are helping a lot of people to get their things back from the hotels, and you have a kind of no cure, no pay business model, right? So you get some of it, and the package or post company will get something also. Postal.
Exactly. That's for everything on the entry.
Yeah. Cool. So let's try to look into these 4 questions that I just briefly mentioned before. So let's start with the first one. First of all, you can maybe tell us about how old is the company actually, Kasper? In relation to that, also, of course, what did it take financially and organizationally to reach the current stage? Financially, I know that you haven't invested that much money, but maybe you have invested some of your own money. But can you take us through this? How did you reach the current stage, and when did you start?
Of course, So I actually started during school, where the SU was a really good source of capital investment. And then I went on to have a full-time job, and then we quit our jobs just before COVID. So basically, up until that point, I didn't require any capital investment except for this one I called forfeit salary levels. Then during COVID, we got some grants and loan from Faundit, because basically we went from having revenue to nothing at all. So we started this, perhaps this investment route track where we want to see, okay, can this actually fly as an investment case? And I think the big learning was that it's difficult. So we tried to hire salespeople because we just want to grow. That's basically what we wanted. But we realized that they didn't perform. That's what I tried to kind of recap in that pie chart, where you see that only 3% of all the LTV that we want is actually from these salespeople that we invested highly in. And we just figured out that my time was actually well spent grinding and chasing taking deals. So yeah, in total, it's the 340,000 euros that we spent, which is all gone to salary, basically.
So I think we'll get back to this one, but so the reason why you haven't raised capital yet is that you haven't found the golden formula for scaling up your sales model, you can say. Is that right?
Yeah, that's exactly it. So honestly, it's all about finding the recipe, and so we tried on our own dime to see if we can find the recipe, because when you know what the bonfire looks like, it's just about the fuel. So we've been struggling or grinding and working hard to find the recipe, and doing it on our own money makes all the mistakes that much cheaper. So we have a clean cap table now, and we are, I'd say, we reached the point where we know the recipe now.
Yeah, cool. Okay, let's move to the next question. So of course, this is a SaaS event. So what are your most important SaaS metrics? You have already told us about the LTV and some of this, but what is your priorities, and how have the measures? Yeah, we can also see it here from the slide. How have these metrics developed over time?
Yeah, I think that's a super interesting question. Well, when we spoke first, I think that's a good thing to consider, all of this. Bootstrapped versus a big company, and how you are tracking these metrics. So basically, from our point of view, I love to track all the metrics. I'm an economist, so I love metrics. But in the end, we just focus so much on grinding that we don't really have the time to build all of these amazing metrics. So we have very few metrics that we then care a lot about. And basically try to find the metrics that are having more of an impact in our day-to-day lives. So for example, the ARR is, it's a nice metric, it works, but it's really good for comparing businesses. But by the end of the day, being bootstrapped, we need to make sure that we have money in the bank so we can pay the salaries to ourselves and to our employees. So that kind of, always takes over. So some of the nice ones that we actually try to track is the LTV, as you can also see from my slide. That's one that we care a lot about, because obviously how much LTV can we sign, but also can we increase the value of our user or our member, and that's what we focus a lot about. See, okay, can we gain a little bit more from this guy? And that's basically a big point in our day-to-day operations, is talking about, okay, how can we tweak and perfect this? And another thing that is really important to consider for a SaaS company in our stage is that the data is not really clean. As we also spoke about, Kasper, you have the CAC, which is it's a great metric, but by the end of the day, if we don't have the right salary levels, then the CAC is not a valid CAC that you can actually go in and use in a scalable sense. And the same with churn, as I mentioned before. Obviously, we only have 500 members, which I'm damn proud of. But 500 is not a lot when you think about churning, and when you think about when are we losing this member? Because right now we're not losing anyone. maybe one or two, but that's difficult to actually build, a clean metric on that you can take with you and scale on.
Yeah. Cool. And so yeah, do you have anything?
So you introduced me to this rule of 40, which I didn't know about because I'm not spending as much time as I like on this on all these metrics. But I think that's a really good metric actually when you also consider Bootstrapped, because we don't have the funds to basically just skyrocket our growth, but then we are very focused on our margins. So it's a good metric to kind of take both sides into consideration. Yeah.
Okay. All right. So our third deep dive question concerns more about how external investors, how should they keep track on your company? And of course, this is not so relevant for you because you are not listed like Penneo and also Efecte are, but so you are not required to report to the market, of course, and these metrics are relatively new to, or you don't track them as much as some of the larger listed companies do. But however, looking at your business model, what should an investor, or basically yourself as the owner, keep more track on, also to moving ahead, maybe not only the LTV CAC ratio, but also you mentioned the rule of 40, and so do you have some insights about how can investors maybe track some companies being private?
Yeah, and that's also what kind of triggered my interest in this event, was that the metrics are difficult, and as I said before, it's super difficult to measure when you are in our kind of state where the CAC is difficult, the churn is difficult. So I kind of thought to myself, okay, what should we consider for a company in our stage, and especially when you think about, okay, let's take a company that's unfunded and let's try to fund this company. So you're thinking about, okay, how can we take what they're doing and then scale that? And as you can see from our team slide, right now I'm the only salesman. We've had 4 in total. Right now I'm the only salesman, but you cannot just get more founders. There's always a founder sales impact the passion of the founder, so that's difficult to scale. So one thing that I thought about was kind of seeing, okay, in this sales recipe, where can we see where the source of revenue is from, and then can we take out all the the passion, heartfelt grind, which comes from a lot of outbound, a lot of referrals, and then can we see, okay, how are they actually progressing with this more scalable metrics, such as the paid ads and the organic, which I just did a graph of in the bottom. As you can see, we're still at the point where it's a lot about still the grinding and the passion, but we are moving more towards this paid ads, because that's scalable, that's the market strategy. And then I would definitely look at that. And I came up with some other fun metrics. I said, do they know what the hell they are doing metric?
That's a new one, Kasper.
Yeah, and it's patent pending. No, but in all seriousness, I think this is super valid for a company like us, because basically you're taking something like an amateur company and see, okay, can we run this professionally? And I think the first step to checking this is to see, okay, are they actually progressing? Are they tracking what they do? So that's something that our advisory board helped us to actually do. So I just included a picture of our reporting where we each month track our progress to see, okay, the budget that we set and the cost that we are expecting to have, are we actually on track with this? Because obviously anyone can always just say that, hey, we're gonna grow like tenfold in 2 months, which I think unfortunately is happening a lot also in the trader market, where you don't really hit your targets. But it's even easier as a bootstrap company to just come up with some bullshit numbers and then we didn't hit that, but that's because of XYZ. So if they can show like say 6 months, 12 months of actually tracking their traction and seeing, okay, they can hit their targets, then I feel more confident as an investor to actually give them my money and feel like, okay, they know what they're doing with this money.
So under promise, over deliver, right?
Yeah, exactly.
Yeah.
But then you kind of do two budgets. One budget that's under promising, and then the other one you have on your sales scoreboard, where it's okay, we're gonna hit 40 deals, but we only hit 20, but it's still good.
Yeah, cool. All right, so the last question here, of course, we have also touched a bit about, you haven't found the golden formula yet for scaling up, but what can potentially change your develop stage? Also, right now you're concerned you need to have the cash on balance before you can invest, and you're of course bootstrapped, but obviously it's also a tough time right now to raise capital if you actually had the golden formula right now, because I guess the wholesale industry is doing very good right now after people being out of COVID, and we want to travel, and we are living on hotels and so on, and we forgot some things last summer because we had to go to the next hotel and so on. So I guess that the industry is quite good right now, but it's very tough to raise capital right now. So what is your considerations if you actually have the golden formula right now?
So we've always been considering whether or not we should, take this route. We've had 2 letters of intent signed, which we or they abandoned for last week because of restrictions and so on. So it's always been in our mind to do it. But I think there are a few things that are key to consider. One of them, which is up right now, is the fact that we are cash flow positive. So taking in an investment, you intentionally go from being this profitable, healthy company into something that burns a lot of money, and we haven't shown yet that we can take in a lot of money and then ramp up our recipe. So we need to have confidence before we actually go out and say that, okay, you can now trust me with your money. I'm gonna make them fly. And then the other thing is obviously this timing, matching elements. So we've always been considering. We've always been going away from it because of XYZ. And in our case, we found a lot of confidence in our advisory board, where we got this. You got the smart money without the money to kind of guide you. But if you can find both in one investor, that's amazing. And that's something that I know from my friends and other people in the industry. It just takes a lot of time to find this perfect match, and that's something that's always holding us back, because basically you have to go out there, you have to create a lot of hype and documentation and pitches and so on, and you're gonna get a lot of no's. It's gonna take a lot of time, and basically if I'm the one doing that, I'll be removing myself from all the grinding and all the passion and all the heartfelt face-to-face with my customers. So we would be removing all that, effect that I have on the sales. So that's very much a pros and cons, like a cost-benefit analysis for us. I think eventually when we see that we are more and more able to take the recipe and then have other people close the deal, except for me, then it's a no-brainer. Because in the end, what we want, what we want is speed, and we want to get to market first. We want to grow big. And regarding your question on the market right now, we are in a lucky position that we have the cap table ourselves, so we could care less about what kind of returns do our investors need, what kind of evaluation are we going to market with, because we don't have this state where we need to always increase our investors' returns on the valuations.
Yeah.
Does that make sense?
Yeah, it does.
Okay.
And yeah, I think some of the companies that have external investors need or have some kind of also pressure to right now. Maybe we can talk about that later also, but they need to shift the business model to focus now more on their capital and the cash flows, and not only on growth as they did last year. So this is also what we see right now. And you don't have this problem because you haven't raised capital and you are bootstrapped. So that's another issue, or that's not an issue right now.
Yeah, but actually, just a note on that. One friend that I have in the VC industry, he said that during COVID, he said that it's not impressive just to stay alive. So basically, you can be cash flow positive with low costs, but then you're just doing like let's say flatlining. So that that's also something that we have to consider. Just being cash flow positive is not nice. No. You have to show that you have this incredible progress while you're being cash flow positive. So it's kind of a pros and cons. If you can only get one, I would always pick the growth.
Perfect. So here in the last 5 minutes of your presentation, we open up the Q&A for, you can say, broader questions. And we have already got some questions for you, Kasper, and these are more general. And I also think that you touched upon it here in the end about some recommendations, or at least how you have been through all these consideration and thoughts. So one question here is, which recommendations do you have for SaaS startups? And do you have any recommendations regarding outside investors? You have already told it, but maybe you can just elaborate a bit more on it, on your and getting into your key points on this question.
Yeah. So I think for the first one, I would my recommendation, if I had to do it all over, is still grind. So keep bootstrapping until you reach like a point of mass where you have enough value and where you have tested enough things. So make all the cheap mistakes on your own time. I would do that any day, and then when you are at a certain stage, you don't need the right recipe yet. But when you are at a stage where you can actually develop it, then it's time to take in the money. Not just focus on always securing funding. Always sales is king, and sales will always be king, and funding is a means to sales. So yeah, my recommendation will always be make sure that you get all the sales first. Make sure you have proof of business, proof of concept, and then you can actually go out to external investors, and it'll also be more interesting for them, because then they know that okay, my money is not just going to be wasted trying out some marketing strategies that 9 out of 10 don't work.
Yeah. And we have a question here. I think you mentioned it before, in terms of the total amount of capital invested in the software / solutions. I'm not sure if you mentioned the 340,000 euro combined with the Vækstfonden loan and some other capital. But if you only look at the solution and the software itself, how much does that require in ballpark, or you can say?
I think that'll probably be about half. So that's kind of some goodwill that's built up. But yeah, so we spend money on salespeople, and then we spend money on developing the product. So it's not more than, let's say, 150,000 to 200,000 euros to actually build a product that's now is live all over Europe and the US, Australia as well. And that's only because we bootstrapped. If we had taken money in from the beginning to actually build the product, it would have been a whole other capital required to actually build it. Yeah.
Kasper, just in the end here, before we end this very insightful presentation, I just want to ask you, I guess you have a kind of land and expand strategy trying to targeting these very large hotel chains. What is next step, and what can we expect to see from you?
Oh, good question. So right now we've just been focusing a lot on sales. We've had some huge deals coming up with some of the biggest groups, where we are actually taking our state-of-the-art software that is unique, and then building it into their systems, so that we're kind of working on this stickiness effect, so that they can't get rid of us. That's something that we always think about. And that's what we do a lot sales-wise, to see how deeply can we put our systems into their system, their software, without them having to lift a finger. And then obviously, I think at one point we will be looking for money, because for me, if I'm going to have to also step away a bit, we need someone else also to drive the growth and the sales. And we are at a time where our marketing is working. We have a lot of referrals. We have we have a dominant position in Denmark and Sweden. Right now, we're trying to scale that to the UK. We just launched our marketing in the UK. So that's next, to see, okay, can we actually take what we've done in our home market we've also called Sweden a home market. Can we do the exact same thing in a more far away market?
Perfect. Kasper, time is up. Thank you very much for this presentation and your valuable insights into being a bootstrap company and your experiences and how this worked for Faundit. So thank you very much, Kasper, being here.
My pleasure. Thanks for having me.
Welcome back. Now it's time for Penneo, a Danish SaaS company which is in the heavy growth investment phase. So we are moving to the next phase where Penneo has invested in a lot of growth activities. We have the pleasure to welcome Penneo's CFO, Kasper Christiansen, who will first introduce the company, and afterwards we will, like we did before, dive into today's topic with the 4 questions. But Kasper, welcome to you, and the word is yours.
Thank you, Kasper. The third Kasper here at Dette. It's a Kasper event today. Well, I'll start out the present Penneo. As you mentioned, we are in this growth phase or heavy growth phase where we have raised capital now second time this year. This presentation is built up until the end of 2021. We are a business-to-business company. We are selling a software solution, and you have defined it in your intro, so I do not need to explain what a software as a service company is. We have a bit more than 2,500 customers on our platform. We are focusing on digital signature and especially all the workflows around the signature and how you can bundle all the send outs. We call it case file, where you can put all the documents in it. And in late 2020, we acquired a company which have built a Know Your Customer platform. So now we're also focusing a lot of that, and I'll come back to that later on. We are today in Denmark, Norway, Sweden especially, and we are also putting a lot of pressure in Belgium, and then we have few customers in Finland and Germany. We have this aim being the platform for auditors in Europe, and that's also the reason why we acquired this Know Your Customer tool, since we now have 2 strong products for the auditors. I'll just dive a bit into the 2 different revenue streams or product we have in Penneo. One of them is the old one, Penneo Sign, and we will later on talk about the phases that we have been through in Penneo. Penneo Sign was built up at the beginning of 12, 13, 14, and we became a more true and ready company with a CVR number and so on in 14. And during this year up until 18, Penneo Sign became a more mature platform and was ready to internationalization and scale at the end of 18, where I also joined the company. Penneo Know Your Customer, as I just told, is a result that we are focusing on auditors, why it makes sense to have the second revenue stream for them, and they know we are a software company wants to solve a lot of problems for them, so they can trust putting their future in our hands. From time to time, in this time, I got the question that how has Penneo performed during a crisis or recession? I think that a lot of us see that we are in the beginning of a recession. Since Penneo is from 14, we have never been in a financial crisis, but we have been in a Penneo Corona situation. And I think no reason for us to talk about that situation, since it puts a lot of pressure on the digital agenda. But to try to answer that question, what can we expect from Penneo in a recession? I have never been on Penneo, have never been in that situation, but we know that our product, the Sign product, is driven by efficiency. You can replace manual tasks, and you can also replace more simple signature solution with a solution where we bundle the case files and make it easy for the end users to sign a lot of documents in the correct order and so on. The Penneo Know Your Customer product is driven by regulation. And I think it's important to notice, since as we are a SaaS company, we are focusing on, are we building a subscription base or are we not? So it's pretty important to think, how can they sell the products also in a more heavy markets. We have the last slide. we have this 3-tiering model focusing on auditing and accounting. And since we also have a strong customer product, we're also, of course, focusing on, for instance, financial institutions, leasing companies, and so on, who is AML government. And the third tier is all the customers, which are end users in our product. Since we build a platform for auditors, we have a lot of end users who is core stakeholders in companies, like executive, board members, and so on. They have our brand fresh in mind, so we try also to sell a strong solution to them.
Yeah.
I think that was the short presentation.
Perfect. That's fine. So let's now move to the more deep dive questions. So what did it take financially and organizationally to reach the current stage? And here you have a lot of more history than, you have been through a lot of phases. So I'm looking forward to hear this, Kasper.
And I have just started out here putting some total numbers, and that's total since we was founded, officially founded in 2014. We have in total a net capital and loan raised on 87 million. So you cannot call us Bootstrapped anymore.
No.
And this is up until the end of 21. And we have, up until the end of 21 last year, spent 52 million in free negative cash. So you can say, that is what we have put in terms of financial cash to growing the company. And what is the result of that? At the end of last year, we had a ARR on 55 million Danish crowns. Why you can see we have approximately 1-to-1. It costs us over time 1 crown every time we raise ARR 1 Danish crown.
Yeah, and Kasper, just for some classification, for some viewers may ask why the capital and loans raised are 87 million and minus the cash and cash equivalents is 25. Why doesn't that sum up to 62 and 52 instead?
According to AFS, there's a lot of costs you not recognize under the free cash flow. For instance, when you raise capital, the cost for raising that capital is not a part of the free cash flow. And also your rent for being here is more like a debt that you pay off over time. So you have some cost, which is liquidity, but it's not a part of the free cash flow. And that's just the IFS standard.
Yeah. Perfect.
And then you also asked the question, during your lifetime, how has the distribution of your employee been, or your organization been? At the beginning, and I guess that Kasper from Faundit could talk more about this, it's about to develop a product and sell a product. At the beginning, it was a pretty much an equal split between sales and development. And when you got more and more mature, we did spend more and more of your capital to hire salespeople to sell the product if the product is ready and ready for scale. So at the beginning of 18, and 18 was the year that I joined, you start to see that we have organizational costs, like me coming in. We become more and more professional, start out being ready for the IPO and start ready for internationalization and so on. And at the same time, your developer, you can see we have 32% spent on our headcount spent on development in 18, and it's 22 now. Since our product is more and more mature, when we're talking about design product, we invest in percentage less headcount into that channel, but we try to invest into the sales organization. And in 18, we also start having this business development, meaning that we do a lot of assessment, what kind of countries should we go into, and try and do desk research and also field research. That's a part of being a more mature and growing up company.
Kasper, just one question to this. Could you see a kind of turning back to more focus on the product development again, or is it in this way it's going down even more? What do you expect?
I expect that I know we raised this money in this spring, the new capital, and a fair share of that portion is also to grow the development, since As I told back in 2020, we acquired the CLA Reply, which was a kind of immature and startup solution around know your customers. We are and have done a lot to mature that product, but there is also a lot to do before it's true scalable. So of course, in terms of coming to this situation where you're ready to scale that product, we are willing to invest a lot into development. And I also think that a software company need to recognize and have respect that you need to develop your solution if you want to win the market. If you're in a situation where you only want to defend what you have already, you can downscale that department. But we want to win the auditors in Europe, while we also need to invest heavily into the development of our platform.
Yeah, makes sense. Cool. Let's move on to the SaaS metrics. So, again asking the question. So, what are your most important SaaS metrics and your priorities, and how have these metrics developed over time? And maybe also for you, being a listed company with transparency, and you've shown these metrics over some years now since you was listed in 2020. How can an external investor follow this? I guess it's more or less some of the same metrics that you are following internal than some of course also external, right? So yeah, let's put the two questions here together and look into the SaaS metrics.
Yeah, and just to be a bit disruptive about this question, I'll start out telling what are we not focusing on. We are not focusing on our EBITDA, but we are still, in terms of the regulation, we need to guide of what do we expect from the EBITDA. But when I wake up in the morning, I'm not having any kind of thought, what is our EBITDA today? We raised money and we want to deploy them. You can put them to product development. That's cost on your balance sheets, or you can invest into, for instance, sales reps or business development and so on. So you need to respect that when you're growing a company and wants to scale it, you also invest into a lot of cost in your P&L. Why it doesn't make sense to follow it that tight, if you ask me. Yeah. I guess that's a personal view on it.
Kasper, before we just go to the SaaS metrics, just one question I know the PLL is boring for SaaS companies, but at least the gross profit or the gross margin is very important to follow. And maybe we can just stick to that in a short moment, because I guess some of these cost of sales is coming from the hosting cost. You are approximately 80%. So a kind of mid-range between what we see looking at 70 at a lower level to 90% at a high level gross margins. What else do we have in the cost of sales category, just before we move on?
EID is the most important ones.
Yeah.
It's a third party. Every time you use Penneo at the night time, for instance, there's no human being in touch with you, but we have this cost to a third party vendor.
Perfect.
And did I answer your?
Yeah, that's fine. So yeah, the idea is some of the main costs.
The idea is that in 21 we was in the last end of the first investment round. So the increase in, for instance, staff cost increased heavily from 2019 to 2020, and then we have a lower increase in the cost there. So this is, if I want to highlight, are we actually following the investment curve? Yeah, we are. Yes, we are. But I think it's more important to focus, if you ask me, on the cash flow that you're actually paying for growing the company. And free cash flow is divided in two. It's like, what are you invest into your product development? That's more mid long-term investment to be relevant also in a half year from now and a year from now. And the second part of the free cash flow is invest heavily into scale the sales organization and so on. But I think, and that's also one of the reasons, and also because of seasonality, when I look at our free cash flow, I always run it, do a 12 months running period, so I annihilate all these fluctuations during the season, and also take into account that it's a combination between long-term, mid-term, and short-term investment. And this is the development for us. You can see that when we was in the bootstrap, and I have put it into brackets since we raised a bit capital at the beginning, while we also have a negative free cash flow corresponding to the AR growth. But when we then got this kind of traction and we do not raise further money, we start seeing that we have a positive free cash flow, and that's kind of the situation you want to be in, unless you think you have a scalable company that you want to fuel with external capital. And that's the situation in this chart. When we entering 19, we raised some bridge funding in 19 and start out this scaling phase. And in 2020, we raised 50 million Danish crown, and then we deployed it. And the year after, we start seeing the results of that. Another important things for an investor to focus on is that even that the company can show there is a healthy relationship between the CAC and the lifetime value. I think if I was an investor in another company, I would look at the historical perspective, at least if there are a historical perspective. All the cohorts over time, are they growing? Are the company actually able to have a net retention rate which is high enough to cover for the churn that you also see in the cohorts? Normally, if this was a quarter report, I'll talk about that we have always seen that from quarter to quarter, all the cohorts are growing positively. I'm not sure it's necessary to be that way, but in overall, you should see a healthy development and not, if you see all the cohorts just falling, maybe it doesn't make sense to fuel that kind of business.
No.
And another info on this slide is this 16.5% net AR growth. All given cohorts, the first 5 years, the customers here, they grow on average 16.5%. The reason why we put these numbers out is that when we later on, and I'll just jump to it, give this SaaS numbers out, you can do your own math when it comes to CAC LTV ratio. Since I don't want to put how long does a customer live in Penneo, since we have only been here since 14. So, and our churn is pretty low, so you can imagine that a customer for more than 20 years, and some will say that's not realistic. So I have just chosen to give you the figures so you can do your own math, just to put a light on that. Another thing is to measure when you develop a portfolio, how is it actually the split between the revenues that the company have? For instance, if we don't acquire CLA back in 2020, we will only have one product. So you can ask yourself, when all the cohorts getting older and older, is it then still possible for the company to have this positive net retention rate? And I think it's a pretty fair and valid question. But our strategy is then to create a new revenue stream for the same customers, so we can still be relevant and do uplift on the same portfolio. And as I showed on some of the first slide, we have approximately 800 auditors and approximately 780 AML relevant customers. So it makes sense to acquire this company and then offer a second revenue streams. And this chart shows how it goes in a period of 12 months. And back in 2020, when we raised the first round of capital during the IPO, we also said that we want to set out for an internationalization of Penneo, why it's relevant for all our investors to track, are they actually about to do this internationalization, or are they still a Danish company? I guess a lot of stakeholders in Danish company know about Penneo, but how is it going outside of Denmark? That's the reason why we always show this chart. Yeah, and this, as I showed before, here you can see how much does it cost to get a new customer in, and what is the first year of AR on that customers, and what is the average revenue per account. And I think you need to combine that knowledge with the historical perspective, since you can have a lucky quarter or year here, but it's pretty hard to have a lucky lifetime.
True. Perfect. Let's move on to the last and maybe also the most interesting question for you, Kasper. So we are seeing many growth companies right now change their focus, scaling down their sales activities and focus more on on the cash flow, also in terms of the limited access to new capital. What can potentially change your development stage or your investment phase concerning the growth versus profitability phase and also value creation? And I know that, as you said, you have raised capital, so you are not in a problem right now, but what is your thoughts and concerns about this one?
Yeah. First of all, of course, I'm pretty glad that we succeed raising the capital just the day that Putin entering Ukraine. So it was lucky to get in just in time for that kind of transactions. But even that we have cash on account, it doesn't mean that we just, we are in a hiring mode, but we also always do our cash flow projections, and we're always running like 2 years ahead. And we can also always see that when we have the dip, because a part of raising capital is also that you're in a SaaS company, that you hire a lot of people that you can't afford. You simply front load all your costs, and then you calculate what should the benefit out of that be. And when you do this math, and every month when we close a month, then we recalculate our cash flow. And in our company, we have this policy: don't deploy cash that you cannot see on your account. So you cannot trust that in a year from now we can raise capital, so we can just burn. You'll never do like that. So even if we have cash on account, if we want to hire more than what's in our hiring plan right now, we need to raise further cash, even that it doesn't make sense since it's only on the account. But that's kind of our policy to make sure that even that the capital markets is pretty negative, we will always have cash enough to run our company. But I think during this period we need to maintain the KPIs, for instance, in sales and marketing, because if we want to raise capital a second round, as we just did, then we need to show a strong track line when it comes to all the SaaS numbers. And we also need to show that it has been a fair price for the new AR crowns that we added in. And we need to show that we have done some great achievements. For instance, the European trust list projects that we expect to be done within this year. You cannot see that on AR on short term, but I can trust you that this is a very heavy project, and it can support your brand also outside of Denmark. It's not important for Denmark, but outside of Denmark, it's pretty important. So I think that if we want to, and we do not need to, but if we want to raise further capital when we come to, for instance, 24, we need to have shown a healthy relationship between cost and by free cash flow, negative free cash flow, and AR growth, and also other achievements that we have paid for.
Yeah, and it makes sense, but I guess you cannot give us a ratio if it's -1, -2, -3. The ratio between the free cash flow over the net new ARR. But as long as these are strong as they are now, you say that you will continue investing in your growth activities, right? Because it of course makes sense, as we also mentioned in the introduction about the IRR. The return, right? Yeah.
What I can show is that last time when it was highest, it was 1.8. And I will say that, and now you and your colleagues showed this chart, and I actually screenshot. I think it's pretty cool. And I do the math, and I could see that we was in a healthy conditions since we have pretty low churn, and we have a pretty strong relationship between growth and negative cash flow.
Yeah.
So I guess that you are more professional when it comes to have an opinion about it, but I think as long as you are around the two, it's fair enough since you are in this heavy investment period.
Yeah, perfect. We have some few minutes back here. Should we leave it up to the Q&A? Actually, in terms of this one about the investors look at the metrics, there's a question outside from one of the participants. How are your institutional investors tracking your SaaS metrics? So maybe you can give us some insights on what does that matter for them when they are having their follow-up meetings with you after a Q report or something like that? How much do they focus on this?
I think what is important to highlight here, they are focusing on long-term goals.
Yeah.
They're not focusing on a quarter. So we are more talking about how does it go, and you have taken some decision during the quarter, and how can that be? Does it make sense or does it not make sense? And what is important is that if you say something, you need to show it. And you need to do it over a long period. You cannot just telling stories and after a quarter it's okay, then you come up. Also what Kasper says from Faundit, you cannot just come up with stories quarter from quarter. You need to be realistic, and you need to work with it. And of course the world can change. Now we have a recession. Of course there can come some change in your calculation, but you need to be honest and direct, and of course report on these numbers. But just to highlight, the most important takeaway here is that it's a medium long-term relationship. It's not a short-term relationship.
Perfect. And you have already mentioned about the recession fears and what we maybe or maybe not go into right now, but just one question outside here. Can you provide any update on the current market situation? So maybe more short term of what you see now, maybe some competitors or some insights. Maybe you can just give us some ideas, or you can say that we have to wait for the Q3.
Yeah, that's my words. I think we're too far from the Q2 reports and too close to the Q2 reports. So I can't give you any kind of...
That's okay. Thank you very much, Kasper. At least we were very into your business after this presentation. So thank you very much for being here and taking us through this presentation.
A pleasure. Thank you for hosting it.
Now it's time for Efecte, a Finnish company that is in the balance growth phase, as we call it. So they have been through all these phases that we have talked before. So after the bootstrap and in the heavy growth investments, now they're in the balance growth phase. And we have the pleasure to welcome Efecte's CEO, Niilo Fredriksson. And I hope I said it right, but you will at least introduce the company, and afterwards we will also go through the deep dive questions as we did before. So first of all, it's a pleasure to having you here today, Niilo. Thank you.
Yes, thank you.
Would you please start your presentation, a short introduction of Efecte?
Okay, absolutely. So hey, thanks so much. My pleasure being here. Hello, everybody online. So just to double check on the timing, it's about 20 minutes now, right?
Yeah, that's perfect.
Possibly some Q&A. So hey, just you double checking also the slides. You see the slides, right?
Yes, we do. So you can just shift it. That's perfect.
Okay, great. So hey, my name is Niilo. I'm CEO of Efecte now for 4 years. And I'll start with a brief introduction into what do we actually do. Because with all these SaaS businesses, as you know, it might be a little bit unclear. Like, what's the actual problem we solve for whom, what do they pay us, etc. I mean, lots of nice words, but what's the reality? And I'll start with this conceptual view into kind of, what kind of benefits we provide and to whom. I mean, we say we help people to digitalize and automate their work. And for all of us, like from an employee point of view in any organization, what it means, being able to get and provide help more effortlessly, whether it's IT problems, HR problems, or any other problems we encounter during the day where we need help from colleagues. And then from a management point of view, it's about improving employee experience, increasing productivity, and saving cost. And how is that done? Like, how do we actually achieve that? So some of you might have seen this, but I'm sure not everybody's familiar. So I'll walk you through the basic use case of Efecte, which hopefully sheds some light on what it is in concrete terms. So let's imagine a typical Efecte customer, thousands of people. They have an IT department, they have an HR department, facilities management, etc. And the gentleman on the left, let's call him Klaus. He's an office worker. And during his day, he has different needs. The laptop doesn't work, or there is a problem with the payslip, or office needs renovation. Now, for this example, let's pick an IT problem. That's where we originally started, IT service management. So let's say his printer is broken. And back in the days, he would kind of out in the hallways search for an IT support person, or maybe call somebody or email somebody. But now, as his organization is using Efecte, there is a self-service portal he can access with the laptop or mobile phone and essentially say that, hey, I have a problem, my printer doesn't work. He might get some suggestions for self-help, plug it in, boot it, see if it works. If it doesn't, he can create a so-called ticket, a service request, that is. And Efecte will then route that ticket to an appropriate support person in Klaus's own organization, in the IT department in this case. And you see her on the right-hand side. Let's call her Susan. So she works in IT support. She receives the ticket inside Efecte, realizes, okay, Klaus has a problem with the printer. From the built-in asset management, she sees also, when was that printer purchased? How old is it? When was it updated? Is there any other history? Also, Efecte's AI-based features help her solve the issue. So she will get recommendations based on previous similar issues that have come up and how they were resolved. Now, it might be that the new printer needs to be purchased, it's beyond repair. That's another scenario where Efecte's workflow will help her. So there is approval workflow. Somebody maybe needs to say, yes, approved, we can buy a new printer. And a new printer needs to be ordered. And all of that can happen inside Efecte. And obviously, the ticket travels always back to Klaus. He has the opportunity to say that, okay, I'm happy with somebody coming in a few days and installing the new printer. Or he can say, no, I'm not happy. There is something else I need. And while this example is an IT example, a lot of our growth has recently come from what we call enterprise service management, which means using the exactly same tool, Efecte in this case, for different type of internal business service processes. So not IT, but for example, HR. So there might be a central HR team which can provide help with vacations, with employment terms, with onboarding, offboarding. There might be a legal department who also needs an interface for people asking help, etc. And that's where a lot of our growth is coming from. So it's not pure IT support these days, but that is the original use case of Efecte, how it all started. So hey, hope that makes sense. Yeah. Opens up a little bit what we do. The next question, like, so why Efecte? There are other tools like that. And there are three differentiators on which we have bet long term, and we're continuing to invest, and then the plus one. The three are agility, experience, and TCO. Agility referring to the customer's ability to take Efecte fast into use and implement changes easily through the graphical user interface, as opposed to always having to have a massive project. Experience, or joy to use, as we label it here on the slide, refers to our commitment to providing world-class user experiences for the users of our software and world-class customer experience for our customers. And finally, we do want Efecte to fit your budget. So TCO-wise, Efecte fares well in the comparison to several competitors. And that's something which is not just about a price point, it's also about the predictability and simplicity of pricing, for which we keep getting good feedback. And then finally, the plus one, what we call cloud on your own terms. That's something that's always been there, but maybe come up a little bit more recently. Also, the geopolitical situation does play a role there, where some customers in critical industries such as defense, financial services, some public sector functions do place value on being able to control from where the cloud service is provided. And our technical architecture provides quite a nice model of how we can provide the full SaaS experience with the evergreen quarterly upgrades, always running on the latest version, monitoring the full SLA. But if the customer needs, we can run the bits in a data center or cloud of their choice. Alrighty, so then now hopefully you have a sense of what we do, how we compete out in the marketplace.
Yeah, and Niilo, I think this one leads us to maybe some of these deep dive questions for this event. So we can see the timeline here. So the question is, or one of the first questions, as I mentioned before, what did it take financially and organizationally to reach the current state? So we can see that you were listed in 2017. What about before that? What did you change from a SaaS business model or from a consultancy or on-premise? Or can you maybe shed some lights on also what has been before that and maybe your investments in the company?
Yeah, sure. So originally Efecte was founded in 1998 under the name of Bitmount Systems and soon renamed Efecte. Obviously in that 20 plus years, there are ups and downs. There was the first growth phase in Finland. There were some ventures outside Finland, and for a while some of that even quite successful. Then the financial crisis hit, and Efecte suffered quite badly with the then business model, all on-premise license and maintenance, and really kind of things went down. However, then in 2013 or so, there was a decision to move on the SaaS model and move technically into the cloud. And ever since we've been growing again. And there was a round of investment or rounds of investment back in the days, way before my time, 10, 15, 20 years ago. I don't even know the exact amounts, but we are still talking about millions of euros at the time. With the IPO and listing on First North, we took in 6 million euros. And that was for the purpose of really accelerating international growth, which we have now done. And of course, there is more of that to be done. But we've used that money to ramp up the business, especially in Germany.
Yeah. So in that ramp up period, I guess you wasn't cash flow positive. So it's something that you've been over the past 2 years or so. Is that right?
Yeah, correct. So 18 and 19 we were deep in the red, and then sort of turned around the cash flow and profitability. 2020 was still not making the break even, but 21 and then so far in 22 we've been faring quite well from that point of view. Cash flow turned already a little bit earlier, so cash flow has been in a way leading in our case. The cash flow turned positive before then the EBITDA and EBIT. Yeah.
Okay, cool. All right, Niilo, maybe we should move on to some of the SaaS metrics and how you measure your what is the most important SaaS metrics for you to follow and also your priorities. I guess you have some slides later on to, perfect. Can you maybe elaborate on your focus on this and how you see these? I can see the churn of 2% is of course very low. Is that something that you expect to continue, or what is your thoughts on this?
Yeah, there are a couple of good questions there. So let me first start with the overall concept and kind of choice of metrics. So I'll start with the ARR. Obviously, that's the metric ultimately for SaaS businesses. And we've been consistent in growing the ARR and MRR as we measure it. Now I think already 19 quarters in a row, 20+% SaaS growth. The recurring gross margin is something that I think is super important because it speaks to the inherent profit generating ability of that particular SaaS equation. And then sometimes you see businesses where you pour lots of money onto it, and then it's always negative, and kind of there's always a promise that in a few years, but then you realize that actually even the base unit economics don't quite scale, don't quite work out. So that's why we put quite a bit of focus on ensuring that recurring gross margin is there. To me, that's a key indicator of our ability to turn the profitability levers up at some point if we choose to.
Yeah.
And then NRR and churn, obviously kind of two sides of, in a way, the same coin, or churn being a component of the net retention rate. I said many times that the 2% churn at the moment for the last 12 months, it's a rolling 12-month metric for us. It's exceptionally low. So I don't accept it to be all the time like that. We've always been around that 5% or less ballpark. That's what I consider a good level for our type of B2B SaaS business. So that's kind of the ballpark where we try to keep it.
Yeah. What about the SaaS growth in terms of your you can say your development from being a more investing in growth activities company to a more balanced growth and focusing on cash flow? Has it been declining over the past years, and then more focus on EBITDA and cash flow, or how much has the growth been above 50-60% organically?
Yeah, so it's that SaaS growth has been there for many quarters. So it's not actually. I think I even have a slide there. Let me just no, the other direction. I'm learning to use your
no problem
interface here for presenters. So hey, here we go. So as you can see, so it's been super consistent now for an extended period of time. Of course, every year, the base numbers grow every year when you count it in. I mean, percentage-wise, it's easy to say, hey, let's keep 20% every year. But euro-wise, of course, it means much more today than what it meant in 2019. So far, we've been able to keep that going. And of course, everything we do focuses on being able to grow as fast as possible.
Yeah. All right. Makes sense. And I also noticed that you made a strategy change. So you actually moved a bit back to the growth focus again. Is that right? And why did you do that?
Well, look, I mean, it goes back to our vision. The vision we have is to build the clear number one player in Europe in this space, be the what we call the leading European alternative in service management, and alternative meaning alternative to the global Goliaths that do dominate this industry.
Yes, such as ServiceNow, right?
The case. Yeah, it's ServiceNow and a few others, but of course ServiceNow is way beyond anybody else if you look at either revenue or market cap. So that is the biggest single competitor by far. And we are focusing on the mid market and European public sector, and providing for them a strong alternative to ServiceNow.
Yeah. Okay. So you need to invest more in growth is to reach your vision, right? That's the answer.
Yeah, it is. But of course, at the same time, I do want to point out that it's still a balanced view. We've always at Efecte kind of liked the concept of balanced growth. So we never kind of went all in. Maybe immediately after the IPO, there was a kind of pretty deep investment phase, and maybe it took a little bit longer at the time than planned originally. But now, if you look at the recent history, last 2-3 years, we've really kind of optimized for that balanced growth where we grow, but at the same time, we take care also of the cash flow and the bottom line, and the LTV CAC. One of the SaaS metrics we did not discuss. Of course, it's at the high level and it points towards it making sense to invest in the go-to-market. So that's why we don't want to maximize the profit right now, because we think it does make sense to keep investing. But at the same time, we want to do it in a responsible way. And this was before. I mean, nothing changed here now with the recent events of the last six months. And as you can see, the plan is that we will be able to finance the base plan, the base growth plan from cash flow. But of course, then there is also the inorganic component, where we made the first move on this summer, acquiring Intellivise from Poland, and the idea is not to stop there if we can find other good targets.
Yeah, because we actually have a question outside here from one asking how much of your growth comes from acquisitions, and have you used the capital markets to raise capital? So this was your first M&A, right? Or acquisition. So you all the numbers are organically.
Yeah, correct. So that's something that we just now concluded recently. We haven't yet reported any. I mean, everything that's out in terms of numbers is pure organic, because it's the first acquisition we did, and then in the Q3 report for the first time we'll present some joint numbers, including Intellivise. And from a financing point of view, we made the transaction. We used our cash balance for that, and there was a small financial loan we took, more to just ensure liquidity for any unexpected things than for really needing it.
Yeah. And we also have another question. Maybe we can also get back to if you have anything else in your presentation, but let's just take one more question here about are you expected to be hit by the recession talk? So you've just showed us some very stable growth rates, about 20 or above 20% over the past years. So how do you see the current market situation and also the recession talk, and how that may or may not affect your business?
Love it. Great question. Something, of course, we think about as well. So let's take this as a background. So now, of course, first, let me state the obvious, that nobody knows for sure, right? Maybe the recession is deep, maybe it's long, maybe not. How much it hits the IT sector, the digitalization wave, all of that. Nobody knows for sure. What is in our control is, of course, how we go to market, what kind of product we build, how we engage with the customers. So far, we have seen some customers be impacted and start to maybe delay decision making. There's been a few individual cases of businesses who were big on Russia or in Belarus, and obviously it's a difficult situation for them, which impacts their ability to spend on things. So we've seen some of that, but then at the same time, if you look at our results so far in the year that we've published, and also the guidance that we have in place for the year, those are, I would say, strong indications of our confidence that nothing dramatic is kind of ahead of us now. And when it comes to next year, obviously we're planning, and the way we look at things is that of course there are some challenges we need to address, but also all the challenges and changes in the market present also opportunities. They present opportunities for organic things, maybe winning market share, even if market growth would slow down, maybe there is an opportunity for that. They present also inorganic opportunities, where transactions which just 6 months ago might not have been possible because of the crazy valuations, they might have come possible. So that's how we look at it.
Yeah. And now, of course, this topic for this deep dive is concerned about the investment phase. And even though you are still a high-growing SaaS company, you are, at least for this event, at the mature or the latest stage for the 3 companies that we have today. So let me just ask, could there be anything that could change your investment phase or your life cycle phase to be even a dividend paying company? And yeah, I also think you have it on one of the last slides. So right now you're not having you're not distributing your capital out to the investors. But what could change or trigger that you would do that?
Yeah, well. First of all, I mean, our current approach is clear, right? We have a strategy that we updated in March in our Capital Markets Day. And by the way, if anyone's interested in kind of a deeper dive, highly recommend the presentations from there. Can be found on our investor pages. And now it's about executing that plan. We laid out a vision of eventually becoming a 100 million business, the clear European leader, getting to 35 million, so essentially doubling the business from last year in just 3 years by 2025. And so far we are on track, and we see no reason to change the plan now suddenly just because of some externals. Now that said, we are a responsible leadership team. There is a very kind of senior and responsible board of directors. So of course we are aware. We monitor the situation, and if there would be some changes that would make us think that for generating the best value for our shareholders, for our customers, for our employees, that if we would come to the conclusion that in this situation it would mean starting to optimize for profitability and dividends, so be it. But just to be clear, there is nothing like that in the plans at the moment.
Perfect. Niilo, time is up. Thank you very much for your insightful presentation here, and very interesting to see, and good luck in the future with all the strategies and plans and so on. So hope to have you back one day, but thank you very much for today.
Yeah, I appreciate it. Thank you all for watching, and see you soon.
See you. Yes, so as we are back again with the final presentation, or you can say it's concluding remarks from Antti and I. So we have been through the 3 presentations here. Very interesting. Antti, do you have some comments here from the beginning that you would like to share, or what you have heard, some key points?
Yeah, I think what we heard in the presentations was really seeing the differences between the companies and how they look at things, especially in the earlier phase. It's really about figuring out how to run the business and what's the efficient model. And that was sort of the priority. And then looking really closely to the figures, how they develop to stay on track. Which, of course, if you're a listed company in the early stage, is harder to give that frequent figures out. But in any case, there's a lot of happening in the early stage. And I think there was a lot of similarity between Penneo and Efecte in terms of what they do with capital allocation. So there is this notion of thinking of what to do to get the best return for the capital. And while Efecte is more mature, I would say, than Penneo, there's still the same mentality that I guess is sort of born out of the heavy investment phase, where you try to figure out how to create the most value. And even after you turn a profit, you're still looking at that. So what should I do with the cash flow I'm generating? Should that be invested back into the business, or should we go into the dividend phase? And for these companies, it seems clear that investing into the growth is the one that makes sense most right now.
Yeah. Very interesting. And before we'll go into the slide that is shown here, I will also just highlight that, of course, this was a deep dive event. So we was very much focusing on the life cycle and the ratios and, the SaaS metrics. But of course, right now, investors should not look backwards, but look forward, because we are looking into a very fearful world, you can say right now, at least both macroeconomically, but also in terms of, all the things going on with both maybe a war and the increasing interest rates and difficult ways to or hard times to raise capital and so on. So if we try to look forward, of course, it's very important to see, or at least also ask yourself, is this company recession resilient, or how will that be affected? And this was also something that I saw, that there was some question from the audience, and also the management itself from the companies were actually quite aware of this situation. Of course, they need to be very ready for change their current business model if they need to do that, and the market will change a lot. So, but with that being said, Antti, should we try to dig into our short overview here of the Finnish and the Danish companies? Being listed, of course. We have Faundit in the beginning, which was not listed. It's a private company, so it's not here on the slide, but we have tried to build up for simplicity, some stages and also some software categories. So, Antti, would you please maybe start out with elaborating on this one?
Yeah, well, I'll do that happily. So what we've done, we've put together a mapping how me and Kasper interpret the Danish and Finnish SaaS companies and their development stages, and also the software category they're in. It must be noted that, of course, this is very much subject to interpretation, and this is how me and Kasper view it. But let's take it as roughly right perspective of the markets. So what we wanted to do is now you've seen companies from each category. So what a company does in the early stage, what's important there, what a company is doing in the heavy growth investments phase, what to focus on there, and then how a company is running the profitable growth phase. So if we look at the markets, we see that in the Danish market, which are the red logos or red background logos, there's a lot more early stage companies than there is in Finland. So in Finland, the SaaS sector is much more mature, and we see that the companies have reached typically a higher scale, which has enabled them to be in the position where they can decide whether to invest more in growth or take in profitability. And there are examples of both. So I'd say Efecte and LeadDesk, for example, are prioritizing growth. I would say maybe Heroes as well on the short term, whereas Admicom and Lemonsoft are generating high margins of profitability and more allocating capital to M&A and dividends. And maybe to look at this, and so as an investor, of course, now you have a better view of what it takes for each category of companies to be good and grow and be successful. At least you have a perspective on that. This overview should give you a short list of companies to look into. And of course, we hope that you also got some tools from this event into how to do that. And maybe to put that a little bit together, I guess in the early stage phase, we noticed that there's a lot of happening in the company, and the companies are still figuring out what is the right sales and growth model for them. So in that case, it's good to at least be patient with the company, because not everything happens today. But at the same time, it's important to make sure that whenever the company is reporting, you notice that things are going forward and the company is maturing and figuring out the sales model. And then in the heavy growth investments phase, it's very important to make sure that the company is investing in a way that is generating returns higher than the cost of capital. So, for example, for Penneo, they are tracking how much ARR they're achieving with the free cash flow that they're spending. So that's really important as an investor to look into in the heavy growth investment phase companies. But then also keep in mind the cash constraints. So if a company is burning cash very fast, no matter how efficient those investments are, how good the returns are, if the company runs out of cash, then there's a problem to be solved. So either the company raises capital, or then they have to cut costs quite significantly to get through.
Yeah, and that's also a great point. Sorry to interrupt you, Antti, but how fast can a company actually scale down and change its business model to be profitable? That's also maybe a practicing thing that we are seeing in Denmark for some of the companies right now, which are changing the business model because troubles to raise more capital now. Also getting back to the key point of saying that the Danish companies are more early stage. So they are now at another company that they was 1 year ago, and their plans are changed. So this is of course very exciting to see which of the companies will succeed raising capital and also continuous growth. But some of the companies might also be in a kind of early stage bootstrap company soon because they don't have any capital, and that's not easy for them to scale up, and then they need to be in a kind of bootstrap situation and only increase their growth stepwise and in a small growth rate. Yeah.
Indeed, that's a good thing to add, and I think what Casper from Faundit said was that it's also not a clear-cut decision whether to invest more or whether to bootstrap it, because it's a trade-off between sort of are you getting enough for the money you're raising, or does it make sense to maybe take things a little bit slower and bootstrap it. So even if a company in a heavy growth investment phase decided to slow down and start bootstrapping, it's not necessarily a bad decision, and quite the opposite. It can be a very good decision to make sure they survive another round of growth, or then that might be the push to get them to do the efficiency leap to actually start generating good returns on their future sales, customer acquisition investments.
Yeah, exactly. And of course, this is a very static overview right now that this is, yes, as I said, some of the companies are right now changing their business model and focusing more on profitability. So some of the heavy growth investments may go down in the bootstrap phase right now or soon in few months. So of course, this is also an important point that this is not the correct picture, as you also mentioned in the beginning of these logos. So, but maybe here before we end this event, Antti, we should stick to the recession fears and the recession resilience. So you have an overview of the Finnish companies, and then I can provide some examples for the Danish ones. What do you expect and how these companies will be affected? Yeah.
So I think for now, we've only been served the appetizers of the sort of recession dinner that's ahead. So what the companies have faced now has not been that tough yet. So of course, there are places where we get signals already. For example, with Lead Desk in Finland, they have a lot of customers in the energy sector. And there a lot of, for example, companies that sell energy contracts have not been able to operate due to the volatile prices. So they've seen bankruptcies in their client base. And I think what Niilo mentioned, what Efecte has seen is delayed decisions for some customers. And I think this is a trend across companies. So I don't think there is a fully recession-proof SaaS company. But again, it's good to remember that typically SaaS companies have recurring revenue. So the baseline they have is generally in a pretty good shape because it's repeating. You're getting the revenues every year. The question, as I see it, is more about the level of growth that these companies are able to achieve in a recession. And overall, you would expect that, hey, these companies are helping their customers get efficiency gains, spend less on certain activities. So if times get tough, it would still make sense for their customer base to be using and taking these tools into use. But again, is this something the customers are able to focus on if the time going gets tough? That's difficult to say. And I think the next 6 and 12 months is going to be really valuable in terms of understanding each company's profile and ability to weather a storm from a bad economic situation.
Yeah, and from the Danish side, I totally agree that it's very hard, of course, to say, but and it's also in looking at the growth rates, they might be lower, or at least lower than they expected last year, of course. But we have some examples. For example, the data process. It's not a pure play SaaS company, but it's a part of the digital transformation for the municipalities. And right now, and this could be, the public or this sector might continue its investments, but some maybe it could also change and they could cut their budgets. But I guess that this is more recession resilient than some of the others that are maybe more in a industry that is being hit by some slower growth. If we are thinking about the regulations, I also think the companies that are delivering their software into these industries, this may continue, as we see right now that there's coming new regulations and companies need to adapt to this environment. So I also think that this could be a note to look at companies like this. And we also have some companies here that are kind of usage based in terms of not a standard subscription model over 1 year, but maybe like every month they are getting a cut of the end sale. And this will be very interesting to see these companies, how they actually are selling, and whether they would like a standard subscription model, or if it actually works because customers really like their service or the software. So there's a lot of things to consider. FastPass Corporation is not a big company, it's a small one, but they are within cybersecurity, and this may be very recession resilient also, for example. And we see some different things going on across the companies. So a lot of companies here to look into, at least if you're interested in SaaS companies, both in Denmark and Finland. But be aware that the Danish ones are of course more early stage for some of them, and are also smaller, of course, in that sense.
Yeah. Indeed, and I would also stress that remember to look at the particular company in detail so you understand what their dynamic is. So you understand how much is actually recurring. For example, Heroes in the COVID, they were suffering because they had transaction-related revenues, but now they've packaged those into SaaS revenues, which is recurring. So companies can also have learned from previous times. But remember to do your research, and for that for the Finnish companies we provide our research as well, which you can find on inderes.fi. So it is mostly in Finnish, but it is available.
Yeah, and maybe just a few notes on that. We of course mentioned here that you can follow listed companies here on the websites, and next week I guess and hope that we have the forum in Denmark going on, and then you can get some more details and knowledge about both the SaaS companies and also all other companies in Finland and Denmark. So that could also be a place to discuss these companies, and we will also provide some more content on both the forum and the Inderes DK side over the next weeks. Antti, do you have anything else to add just before we end this?
Maybe I'll add about the forum. So if you have questions about the particular companies, we are at your service. We are somehow in touch with many of these companies. So if you have questions, just come join us at the forums, and we're there to discuss these companies with you. So hope to see you there.
Yeah, perfect. And let that be the last for today. So thank you very much for all of you tuning in for today's deep dive event. We are striving to get even more like this deep dive event today. So maybe kind of looking into the different subscription models, usage-based models, to understand what is the differences and how is it actually going with the contract period. We are having a lot of ideas on how we can kind of look into these different companies, and you as an investor can learn more of the business model. So thank you again very much for listening, and we will also distribute all the videos on YouTube, and I guess also from the Inderes side it will be available on your platform.
Yes, indeed.
Thank you, and bye everyone.